Well, here's an interesting perspective for you. Our next guest says that sunscreen will not be the only important thing to have this summer. He says Trump screen might be important when you're thinking about your investment strategies. I'm joined by Brad Simpson. He's the Chief Wealth Strategist at TD Wealth. Nice to see you.
Yeah, nice to see you.
What's Trump screen?
It's an antidote to all things Trump. When you are going out for a lovely sunny afternoon and you end up talking about Trump the whole time.
Yeah, and you talk about this, and I think it's a great example in your note about going for a barbecue, and suddenly you get into some pretty heated discussions, but we're obsessed with everything that's Trump right
absolutely.
now. Yeah.
Absolutely. I thought, what a wonderful way to spoil a beautiful afternoon. So, but I mean, this is even amongst a group of friends, and it delves very quickly into madness and very strong opinions on both sides, and I couldn't help thinking by how the next day, after thinking about it overnight, that what impact this must have also on how people invest.
Right.
I mean, I guess you're susceptible to your environment around you,
yeah.
And really I came to one of the things that was really clear in this is, and an important piece for us is dealing with behavior and behavioral economics, if you will. And to me, this was a perfect sign of one of the most famous, one of our favorite things that we see investors do, and this is confirmation bias.
Which is what?
Right. Well, really having your view and then searching for any kind of proof that reinforces what you already believe. And so one of the things I just was kind of the takeaways when you get yourself into a discussion about Trump, what happens with confirmation bias is actually the more you make your argument, the more it reinforces what you already believe. And once that's happening with both parties, you're really going to get nowhere with it.
Yeah.
And I kind of draw this analogy to the same part onto the investment, and it kind of reminded me back, if you think during the tech craze, if you met somebody when you were out, and when they started justifying paying 100 times for an internet stock of some sort, whatever argument you made, it just made them reinforced it. And the exact same thing with real estate in 2007 and 8. People would be armed with their data from open houses that they went to, and of course we're seeing some of that today here in Toronto and definitely in Vancouver as well.
Yeah.
So So maybe the one part is kind of a little bit of a warning, is just to remember that necessarily if you hold the view, it isn't the right view, and kind of to step back and kind of challenge your own views before you make such hard-held conversations and biases and decisions that you're making, because it can have a detrimental impact at your what's supposed to be a fun summer party, right? And the second part is it's going to have a really detrimental impact on how you invest.
Yeah, that's a really good point. Advice I need to take. I get into lots of heated arguments about this. So let's say that then people have put on their Trump screen and they plug their ears a bit, I guess, in terms of just the news flow that's coming out. Mm-hmm. You highlight in your note there's a few things that we should take a look at, and the first one is interest rates right now. Yeah,
and I think the right now, if you kind of read through a financial press, or if you looked at that, everything in the market comes down to what is next got the Trump administration, and really, I think we've overdone this.
Yeah.
And the story for the last 6 years has been interest rates, and really, I think that's still the story, and we're distracted for a while, but rates are still the story.
Yeah. You also highlight, in terms of just kind of running through what you think really matters and what people should pay attention to, the first quarter in terms of what happened. And you said, good earnings numbers, good durable goods numbers, but is this as good as it gets? Because that was a really strong quarter.
Yeah, I think there's two parts to that. One is I wanted to be really careful in that this was an excellent earnings seasons this year. I mean, the best since the third quarter of 2011. One thing is I wanted to point out with that is you're seeing some from our neighbors down south, some things starting to come out, some research going, well, the first 100 days of the administration, and boy, look at this quarter, and there's no correlation between the first quarter of 2017 and a presidency that's just getting going. Yeah. So then the second part is that saying then we're getting to the cheerleading, going, well, boy, what a surprise! This was something nobody saw coming. 13.4% growth, everybody's excited. Where is this going to next? And then you go, well, wait a minute. Remember that we compare quarter one 2017 to quarter one 2016. And if we rewinded to 2016, and if you and I were chatting then, it would be, boy, it was kind of a tough quarter there, and we were in the middle of a global market correction.
It's a low bar.
Yeah, and so now all of a sudden, you're comparing a relatively soft quarter with a relatively strong quarter, and you have to keep that in mind.
The other thing that I love that you talk about as well is just, with low interest rates, what it's done to stocks and real estate and all those types of things, but also how the market is very focused on growth right now. And you take a look at the example of Tesla versus Ford.
Right.
One making money, one not. But anyway.
Yeah. So the low interest rates permeate through anything, right? So one of the things when you're in Finance 101 is you're saying, what are you prepared to pay for growth and future cash flows? When interest rates are high, you're prepared to pay less. When interest rates are low, you're willing to pay more. And and then you add to the fact that we live in a world where public companies are pretty clear on creating top line growth is really difficult. So lo and behold, you look at the quarter we just went through, Ford versus Tesla. When Tesla now has a market cap of $53 billion, Ford has a market cap of $49 billion. Looking at the amount of cars they produced in that quarter, Tesla manufactured 25,000 cars. Ford, I believe, was manufactured 1.9 million cars. And you look at reported earnings, Tesla came out and said, listen, we lost $1.33 a share. The analyst community expected 85 cents. Meanwhile, over at Ford, they came out and said they have earnings of 39 cents a share.
Yeah.
The analyst community expected 35. And of course, what happens is, Ford's in trouble and things are going terribly and we have to fire the CEO. And meanwhile, over at Tesla, things are fantastic.
And Elon Musk has even come out and said the valuations are...
Right, or are they overvalued?
Yeah.
Why? Well, if you're at the end of the day, if you look at the revenue growth, it's massive, but it's off it's off a really low baseline, right? But you're prepared to pay that, and you're prepared to keep pushing out for that. And so there's other drivers in that too. There's the narrative around it, and that helps with that. But we're not just seeing that with Tesla. I mean, if you look over at Amazon is a very similar story, far ahead of that. But Amazon almost purposely makes sure that they don't make money in a quarter, and just keep saying we're having this wonderful growth, and the market will keep rewarding you for it. And I think that is indicative of a slow growth economy. And if you are a grower, then you're going to attract the capital.
So let me ask you then, bring this back down to, because there's other factors at play. I mean, China, which you talk a bit about too, in terms of what's going on there, what could slow things down. But if you were to boil this down, given all that's going on, I mean, I don't think there's ever been a market that's been probably more interesting or more active in terms of headlines and such. Yeah. What does it mean for investors right now? What should they be focused on?
Well, I think I think investors should really be focused on a little bit is to kind of try to step back a little bit and have more of a kind of a sober take on things. An investor asked me the other day that, is there a natural baseline for equity investments today? That, if something goes wrong, is there just almost like an automatic support that is there? And those kind of questions are because if you summarize that question, it really means that I'm so used to that if something goes wrong, a central bank is there and magically money flows back into this market, and it just gives me an opportunity again. Really in our view is that there's a lot of things in this market that pose a positive trend. Right, a stronger a quarter of earnings in the United States, but in Canada, particularly, I mean, a really strong quarter, knock your socks off kind of quarter. that of course get you a little bit excited about. Then if you look over in Europe, some really terrific signs. A good business quarter, again, a good business quarter of reporting seasons from them as well. Still early stages of monetary policy. From our perspective at the Wealth Asset Allocation Committee, we've been increasing our exposure there. So those are positives, and I want to stress that. But I think that this natural inclination that we're in, that nothing could ever go wrong, and that we're not going to ever have volatility again, I think you got to be a little bit careful there.
Wise words, Brad. Thanks very much.
Thank you.